Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
Today's sponsor is Audible.com. They're a leading provider of spoken audio information and entertainment. Listen to their audiobooks whenever and wherever you want. You know, I do a lot of driving. I'm always listening to an audiobook, and I love it. I couldn't live without Audible. If interested, go to audiblepodcast.com/Lutz. audiblepodcast.com/Lutz. You are listening to the Financial Survival Network. I'm Kerry Lutz on 1590 WPSL. The market, since the beginning of the year, it just keeps going up. 15,000. Pretty soon, 15,000 will be a memory. Let's talk about it with Jason Burack, our old friend. Jason, welcome back to the Financial Survival Network.
Thanks, Kerry. Glad to be back on.
Hey, what about the market here? Is it going to keep going up? Is this purely liquidity driven, or is there some recovery that I'm not seeing?
Well, there's a recovery in certain sectors. There's actually some real growth in some technology-related sectors like 3D printing, robotics, and data mining. But these are not, large sectors. In general, though, across a lot of the economy, I would say a lot of the sectors are stagnant, and they're really not growing at all, as evidenced by a lot of companies, when they report earnings and their revenue is not really growing. So the reason, though, that the earnings are growing rather and the stock prices are going up, like you said, is the liquidity-driven thing, and it's also the cheap debt that the corporations can borrow, and they're just buying back their shares. So their revenue's not going. This is one of the best cases is IBM. Their revenue hasn't really gone up at all in 10 years, but their earnings has gone up a lot because they keep buying back a lot of their shares. So they just reduced the share count, and that, in essence, is what a lot of corporate CEOs have been doing lately with the cheap debts. One of the misallocations of capital, one of the incorrect market signals that have been going on. I just don't see a lot of fundamental reasons. For the market going up besides the liquidity driven. You look at profit margins, and they are at an all-time high. A lot of the U.S. corporate CEOs have done a very, very good job since 2008, slashing expenses to the bone. But they're not really investing that much in growth. They're holding a lot of cash on the balance sheet. Maybe they do a little small acquisition here or there, but they're mostly just paying dividends and buying back shares, which I guess is okay, for an investor standpoint. But if you're out there looking for a job, it's not very good.
Hey. So it used to be, build a better mousetrap and the world will beat a path to your door and you'll have an IPO and be able to retire wealthy. Now it's basically exploit that mousetrap that you invented 20 years ago, refine it a little bit, buy back your shares, issue debt, and your earnings per share will go up and your stock price will go up as a result. So it's something a little twisted, and I think you hit the nail on the head. It really is malinvestment. Exactly.
And the Federal Reserve and central bankers and Keynesian central planners are sending very, very incorrect signals to the market right now. And, they say there's free market forces. The Keynesians are saying, the Keynesian central bankers and the Keynesian economists on Wall Street are saying, well, if we have free market forces in the bond market, they're saying interest rates should be this low. Look who's buying up all the bonds. The ECB is buying up a lot of the debt. The Japanese central bank is printing yen nonstop, and they're devaluing the yen against the U.S. dollar. They're buying up treasuries, dollars, euros. They're buying up almost anything to devalue the yen. The yen's been really the most spectacular devaluation in the last 12 to 18 months. That thing is down about 25% devaluation against the dollar and even more against the euro. So that's why commodity prices, despite all this inflation, and we've just had humongous asset price inflation. In the last few years, the stock market's up so much. Real estate market looks like the bubble's been reinflated. The bond market's up too. All of these things are not supposed to be rising all at once. If you study conventional finance and investing like I have, there's supposed to be non-correlated assets. The commodities market is not doing what it's supposed to do. The commodities market is just not acting rationally at all right now. It's not showing its proper inflation hedge. You look at what's happened in precious metals, especially in the paper markets compared to the physical. It's just things are not acting the way they're supposed to be. But, in this environment, stocks are going to continue to go up. I don't see a scenario here where if there is a 15 to 20% correction in the market, the Fed's not going to come in and announce that they're going to expand the balance sheet to $150 billion, $200 billion a month because they say that there's no inflation because the interest rates are low, even though they're manipulating the interest rates down with the help of the large Wall Street banks and the over-the-counter derivatives market. So, and they're saying that's free market forces, Kerry. It's just insane.
Hey, Jason, look, free market, they say that's what caused the real estate bust. They always blame it on capitalism. They always blame it on the market. And in fact, we haven't had free markets in this country, in the world, in a century, effectively. Certainly not for interest rates. And every major bust that's occurred is because they're monkeying with forces that they really don't understand. And you wind up getting the tab for it.
Yeah, I completely agree. And capitalism does get the blame. And, people from the mainstream media to government schools where a lot of people are taught, making a profit is evil, entrepreneurship's evil, being a business person is evil. It's just the wrong way to go here because the America that I was raised with and that my great-grandparents came over here to the United States for was their American dream was not to own your own home like the American Realtor Association has spun. The real American dream is to start your own business or freedom and economic opportunity, then make a lot of money, working hard, doing the right thing, maybe building a business, and then after you have all that money, then you can go and buy the toys and all the good things that come after it. Not, getting the credit first, the Keynesian solution here, where they're handing out all this government program money, all this welfare program money, and then everyone's getting free and easy credit. And, people are turning into debt serfs. So it's just very, very weird out there right now. I mean, like I said, the markets are going to continue to go up, but the one place where I do see value is in the commodities market. I've been saying this for a while now, I beat it like a drum. People can get paid to wait in there, and the baby is just being thrown out with the bathwater. I mean, if you look at the valuations on some of these oil stocks, the oil producers, compared to the master limited partnerships, I mean, the valuations on the master limited partnerships are much, much higher than the oil corporations. And the gold and silver stocks have just gotten trashed. Some of them are pricing in gold and silver at, below $1,000 an ounce gold. And the demand for metal is still rising. And with the demand for metal still rising, there's just no way that the mining supply can make any money at gold prices much lower. There's going to be bankruptcies if there's any more of a correction.
Yeah, the world has been stood up on its head, and as somebody said, I think it was Chris Powell, we no longer have markets, we just have interventions, and the government's intervening in markets all over the place. You talk about the housing market getting reinflated. The housing market, yes, is, but only like 2/3 of what the market was back 5-6 years ago, because there's this huge shadow inventory that they're just holding back, artificially restricting the supply, driving the demand with cheap money, cheap mortgages, ergo prices of housing go up. Also, you look at retail sales. It always appears that retail sales go up because all they do is measure same-store sales, stores that have been open for a year or more at least. And when the stores get closed, the index doesn't get adjusted for that. We still see that the retail market is contracting, right?
Yeah, there's a lot of games played with all the statistics. And then you look, another point to add to that in the real estate market is you have a lot of people living in homes who aren't even paying their mortgage, and they're spending their either welfare government checks or they're spending what's left of their salary on consumer items, and they're not paying their mortgage. And they're not being kicked out by the banks. So this is the type of Ponzi economy that we live in right now, where the statistics, I mean, there's a lot of Wall Street people now, Kerry, and this just boggles my mind. They're saying that the economy is recovering, there is no inflation, and that the Federal Reserve will easily be able to get out of its balance sheet problems, and the balance sheet's growing by over $1 trillion a year in 3 to 5 years. There's people saying it's no problem now. And there's people saying the QE program is going to end. It's just insane. This is the same, to give your listeners a comparison here, these are the exact same things with the commodities market that people shouldn't buy. I'm never buying commodities again, that I heard with stocks in 2009 when I bought a lot of stocks for my parents, a lot, Apple at 90, a lot of other dividend stocks, resource stocks that were selling for pennies on the valuation, stuff like that. So this is a type of contrarian indicator that if your listeners want to make money in the markets and they're long-term value investors, are not traders, because I don't know exactly when the commodities market's going to turn around again. I mean, maybe by the end of the year, the Fed announces an expansion to Q infinity. The balance sheet expands drastically, and that's what does it. But right now, it looks like the other countries are devaluing their currencies faster than the dollar. You can see that through the yen. The yen is just, they're up the dollar to devalue the yen, and they're propping up a U.S. Treasury market to devalue the yen.
Yeah, hey, it's obvious it's going to happen. Everything's manipulated. You know, when it goes back, in my mind, you said when your ancestors came here, you know, probably 100 plus years ago, they got on the boat and they weren't thinking about buying a house with an FHA-backed mortgage and getting Obamacare and healthcare and all that. I wonder if you're getting on the boat today, where do you go? Do you go to Chile? Do you go? There's probably half a dozen other places that are freer than the U.S. that offer more opportunity.
Well, Kerry, I think unfortunately, a lot of people are still coming to the U.S. because they think that they can get some opportunities here in the U.S. Because I mean, on a comparative basis, you can still get a $30,000 or $40,000 a year job here in the U.S., which is more money than some people make in another country. The problem here is that a lot of immigrants are not really looking to work hard necessarily. Some of them think that they can get free benefits and take advantage of the taxpayer, blah 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 blah, and I don't know. I don't see that people looking the total amount of people maybe in the past that valued freedom as much as it was valued in the past. I think more people are, with the Benjamin Franklin quote, with security and freedom, and when you value security over freedom, you end up with neither. So I think that's what the world is coming to now. People are just so conditioned by the environment that they've been in with the mainstream media and government schools and all these other sources of information out there that they don't want to work hard on their own. They don't want to build their own business. They think that's more dangerous than working for a corporation, even though you can be fired within a month from your corporation. Now, the stocks for a lot of companies on the New York Stock Exchange really only go up when people get fired, when costs get cut. So, top and bottom line growth, and you got to cut costs. So I think that's what we're looking at. For your listeners out there, though, who want to protect themselves, I mean, look at the disparity in the market here with the paper prices and the supply-demand fundamentals for the metal, though. I have not seen anything like this since 2008. I was buying metal in 2008 and 2009 when no one said to buy, mining stocks. Everyone was like exactly like they are now. Every major Wall Street analyst and all the talking heads, don't buy mining stocks, or gold is going below 700. The bull market's over. Blah 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 blah. And that's when I didn't buy all my position at once, but I was buying quality companies that could still make money at these prices. And that's how you build wealth. So it just depends, what someone wants to do. I mean, the thing about this environment is it's really good for investors like looking for yield and people actually have capital. But for people who want to, find a job, this is going to be very difficult for them. They're going to have to find some technology-related skills or be entrepreneurial. And, hopefully people will get this message out there that they need to work hard. They need to align themselves with the few technology growth sectors that I said, like software, robotics, 3D printing, data mining, healthcare, maybe those types of things, or they're going to just struggle to find any kind of decent job to survive what's coming.
Or petroleum engineering, mining engineer, those fields, there's a whole generation of people that never went there. And petroleum engineer is the best paying job for a college graduate in the country now.
Yeah, I think petroleum is a lot safer than the mining engineers because, you can put a oil and gas field into production normally much, much quicker than a mine. The mining sector really carries since April of 2011. I study mining stocks a lot, probably too much. I've been studying a lot of production costs for mining companies to see maybe which ones could go bankrupt potentially if gold goes down to $1,200 or below, or silver goes back down to $20 an ounce or below. And really, in the last 2 years since April of 2011, like I said, the financing, the amount of financing for miners has dropped over 90%. So it's just insane. how much the things have contracted in the sector, and I don't know if the money is going to come back. I have no idea. But I do know that demand for metals is still rising. So I think, at least for specific commodities with supply-demand fundamentals like gold and silver and a few others, but we are going to see, because, the world population is still over 7 billion. It is growing. There is still demand growth in emerging markets. It has slowed, but it's still growing. We are going to see supply shocks, I think. I think we are going to see supply shocks. They're not going to be immediate, but I think 3 to 5 years from now, I think we're going to see some pretty crazy supply shocks in gold and silver if the paper prices go much lower.
I think you're correct because, like you say, the population's still growing. The middle class of the world is growing by leaps and bounds outside of North America and Western Europe, and these are the drivers. True, perhaps now the economics of mining doesn't look good, but certain things you're going to need copper. You can't get away from that, and it's being depleted. There's so many other elements that are being depleted every single day that even if it looks a little bleak, perhaps for mining engineers right now, it's not going to stay that way for long. That's my opinion anyway. So, Jason, any particular MLPs that you're looking at that look interesting?
Yes. I think the market, in terms of MLPs, since I started covering them a lot more recently, one of the major ones for your listeners, and this is a large company, is Lynn Energy. The valuation has just fallen off a lot. There's a lot of hedge funds shorting the stock right now. And Lynn Energy, they do have commodity price exposure, which for some of the MLP owners out there do not want it, but their dividend yield is very, very high. I believe it's over 8%. And they pay a monthly distribution now. And either you can buy Lynn Energy or Linco, which is a C corporation. So if you just want to buy it as a trade, the Linco would probably be a safer trade, because then you wouldn't have bad tax consequences. But Lynn Energy just did a really good acquisition. It was very accretive. The acquisition closes in a couple months. I think that's a good stock pick for your listeners. But for gold and silver, I think your listeners should really take a look at the royalty and streaming companies. These companies are still making money hand over fist. There's 4 companies that really do it. Franco-Nevada, Royal Gold, Silver Wheaton, and Sandstorm Gold. Their costs are fixed. They don't have to worry. That's one of the major things about the mining industry right now, is that they've had a double whammy, humongous margin compression, where the metals prices have dropped a lot and costs have gone up a lot too. So that's a double whammy. And the royalty and streaming companies haven't had to deal with that. They're still making money hand over fist. They're the only ones with free cash flow. A lot of them don't have any debt. They're well diversified. And they're not going to go out of business. They might have a stream or two that might fail, but they still have a lot of money coming in, and they're the only ones right now with, like I said, very little debt, and they have a lot of cash to do deals. During the 2008 environment, I'll give you an example of how amazing a deal this is. Franco-Nevada bought over $1 billion in net present value gold for an immediately accretive transaction from Coeur d'Alene at their Palmarejo mine for only $80 million.
Wow.
So that mine was because they had cash. They didn't have any debt. They had cash on the balance sheet, and they were just waiting, for an opportunity like that to come along. So Franco invested only $80 million, and the mine was already running. So Coeur d'Alene had a little cost overrun. Franco gave him the cash and bought a bing, 50% life of mine on that gold stream right there. So plus exploration upside. That's how you create value in an environment like this. And those companies, they're not going bankrupt. A few of them pay pretty nice dividends, and the dividends are only going to increase. So that's the way I would ride out the storm in the precious metals. So look for good MLPs. Look for some of those precious metal royalty and streamers above some of the miners. And I think people are going to make a lot of money in 3 years if they don't buy all their position at once, if they buy their position, on dips.
Hey, what's your feeling on this one? I've been looking at for a long time. Don't own it, by the way, and I don't own any of the stocks that you mentioned except Silver Wheaton. I probably own a little bit of that. PVR Partners, which is natural gas. They do some coal, and they're a midstream type operation.
Yeah, well, the thing about PVR is that they're tied a lot to coal prices. So the market... They've done pretty well on the natural gas side, but the market really doesn't like their coal exposure, and the coal prices have not really rebounded at all. In fact, everything there is tied to China. So it really depends on what your view is of China there. What the PVR Partners management has done compared to other managements is the management team, I believe, has been doing insider buying, and they've been trying to buy back some shares with some of the money that they're making, even though they're still like trying to dig themselves out of a hole. So they have made some steps. It's a turnaround play. The thing about turnaround plays is it's all about, will the commodity price come back? Will management be able to solve the problems fast enough? So it's not something I would make a big bet on. I have made a lot of money, though, in the past buying small positions in a couple turnaround plays. So that's what your listeners maybe want to do is, put the majority of their money in safer MLPs like Lynn Energy, Enterprise Products Partners, Kinder Morgan, those types, the ones that, are already making big profits, don't have any turnaround issues or anything like, and their profits are tied to fee-based businesses, and then maybe put a little bit of capital into a more speculative play like a PVR, because they could get, over 100% returns on their money in a couple years, or the company could be in a lot of trouble and end up in bankruptcy. But you know what? It's probably worth the risk at these levels, and we have it as a buy at our firm.
Yeah, and they're paying a dividend, a distribution, if you excuse me. I do know the difference of 8.7%, so that does compensate you for a little bit of risk, perhaps. And yeah, I wouldn't put all my eggs in one basket, but kind of looks interesting. Although, hey, don't listen to me when it comes to buying stocks because you'll lose money for sure. Anyway, Jason, we want to give out your website. Where can you be found?
Sure. Your listeners can check us out at wallstreetformainstreet.com, which is WALLSTFORMAINST.com.
Excellent. Wall Street for Main Street. Don't forget financialsurvivalnetwork.com. Go to the site now, subscribe, get the free newsletter. Jason, good talking to you. We'll talk with you again soon. Be well.
Thank you, Kerry, and hope you're doing well too.
Hi, I'm Kerry Lutz, host of the Financial Survival Network. We talk a lot about investments. We talk a lot about what to do with your money. If you're looking to invest in income-producing property, I recommend Jason Hartman. He's helped thousands of investors realize their dreams and help them to finance their retirements. He can help you find income-producing property anywhere in the country. He's got the know-how and the understanding to help you buy the right property at the right price. But it doesn't end there. He'll show you how to effectively manage your property and get the highest cash flow possible from it. And when it comes to the maximum tax benefits of your real estate investment, Jason is tops. Find Jason at www.jasonhartman.com. That's Jason, HARTMAN.com. Again, jasonhartman.com.